Welcome to the Marketbeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. So in the years I've been in financial services, I've heard over and over again, the 60-40 portfolio is dead. So right before I sat down to record this intro, I Googled the phrase just to see, and I got 377,000 results. So I'm not imagining it when I say I've heard this a lot. In particular, while the market has been extremely volatile this year, it's become a valid question of whether or not the traditional bond allocation will deliver the return investors need, especially if bonds continue underperforming relative to their past returns. And remember, bonds essentially serve the role of dampening the volatility of equities as well as income. But you can never expect your fixed income allocation to bring the same kind of return as stocks. So, what happens when the portion of your portfolio intended to mitigate volatility and help smooth your return is declining at exactly the same time as your equities? Well, we've done quite a few shows here about alternative asset classes, including commodities and real estate. And the idea behind adding those liquid alternatives is to diversify away some of the risk of other asset classes, including fixed income. So, in highly technical terms, wait for it, you want some investments to zig while others zag. But does that necessarily mean just buying a commodities fund and calling it a day? And no shade on commodities funds, right? Those have been strong performers lately, and they have definitely helped to offset some losses in the stock and bond market. But what if there were strategies that could give you a more top-down way of diversifying? In other words, viewing your entire portfolio, not just individual holdings, from an alternative lens. Well, that's exactly the discussion I have with today's guest, Dick Pfister of AlphaCore Wealth Advisory. Today, we really get into the comprehensive view of asset allocation buckets and how they can all work together to generate the return you need. And Dick does offer some specific stocks and funds that he likes as portfolio diversifiers. So today we'll give you a different perspective on the traditional 60-40 portfolio. And that perspective is absolutely necessary as this bout of market uncertainty shows no sign of ending. So give a listen to today's interview with Dick Pfister, founder and CEO of AlphaCore Wealth Advisory. So, Dick, one of the things that you do as an asset manager is diversifying traditional portfolios with alternative strategies. And I wanted to start there today because, there's been so much discussion lately about the traditional 60-40 being dead. I've read so many articles about that in the past year and had so many conversations. But what is the alternative, given the current market volatility that many expect to continue into the foreseeable future? What's the alternative here?
It's a good question. And I think part of our job, my job at AlphaCore, is to demystify what the world of alternatives are and what that means to the average investor. And I think generally speaking, what's happened over the last 10 or even 20 years, the investor has gotten more interested and invested in passive long-only stock index portfolios, whether those are ETFs or mutual funds. Obviously, Vanguard's been kind of the genesis of that, and then it turned into all sorts of other ETFs could be long only in equities. And that we call the passive world of investing. And we do still think that should play a role in most people's portfolios. But what happened over that decade or two is that the passive investor took over the active investor. The active investor was pushed to the wayside, and you kind of read a lot of different studies about active investing is dead now. All you need is long only equities. No active investor is worth their fees. They can't beat the benchmarks. I mean, I've heard that for my entire career.
Right. There are plenty of articles about that. You're absolutely right. There's no shortage.
Yeah, exactly. And that's, in a lot of cases, that's been true. The active investors haven't been able to outpace the market especially a Fed-infused market where the Fed was essentially a put option. Every time the market would go down 5 or 10%, the market would rally back up because the Fed would lower rates, or they'd do QE1 or 2 or 3 or 4 or 5, right? There was a lot of QE that actually helped fuel this market rebound and rally. So we believe we're heading into a new world for the next decade where active comes back to the forefront and active becomes where everybody wants to go. And in that world of actively managed portfolios is one form of alternative investing. And you could call those different things because the world of alternative is essentially an alternative to long-only stocks or long-only bonds, right? That's kind of the generally accepted definition. What's an alternative? And when you start looking in that world and peeling the layers of the onion back further and further, you see, okay, well, this manager might be long some stocks and short some stocks, and that would be a long-short strategy. And that's one type of alternative strategy. One manager might be long commodities and short bonds, and that's another type of alternative strategy. It's kind of important to define what type of alternative you're talking about, and then start to say, okay, what should I expect from this alternative investment going forward? And that's usually how we put together portfolios. We combine traditional stocks and bonds with various alternative strategies.
Now, a lot of our listeners are retail investors, and I think one message that people have gotten over the years, for better or worse, depending on the market cycle, is gold, is precious metals. That a lot of people, I think, have gotten the idea that that's maybe the premier alternative to long equities. What's your take on that?
I think there's this world of commodities that have been traditionally looked at as an alternative, and real estate too. So real assets, we'll call them. We define the world of alternatives in two major buckets. So there are alternative asset classes. Those are things like commodities, so gold, silver, even energies. And then you can get into the whole grains and wheat sector. That's a whole commodities world that you could invest in. And if those go up in price, that's going to give you some inflation protection. Then there's things like private real estate or REITs or private equity. Those are alternative asset classes. And they have a certain correlation to those asset classes, or what we'll call sophisticatedly a beta to those asset classes, right? And we think some of them are good to have in an inflationary environment like we've seen. So obviously energies have soared in the last couple of years, inflation and a variety of things that contributed to that. Gold can be potentially a hedge to inflation. It hasn't turned out to be the best so far, but it can be. And real estate has definitely been an inflation hedge, at least for the last 3 to 5 years. So those are potentially long-only alternative asset classes that could do well. The alternative strategies are much more liquid, more nimble, and actively managed, right? So like I was mentioning, a long-short equity strategy, that's an alternative strategy, but it's not going to be just long one stock for the next 10 years. It might be long a stock for maybe 3 months or 6 months and then out of that stock. And it might be short a stock for 3 or 6 months and then out of that stock. That's a much more actively managed alternative strategy. And then there's alternative asset classes, and you combine the two together, and that's how you get a really diversified way.
So let's talk a little bit about the practicalities then of how you are implementing this right now. And if you are able to, Dick, I'd like to get into some specifics, whether it's broad asset classes, sectors, or even specific securities.
Sure. I think that, the key to, one of my old clients said to me a long time ago is once you've accumulated some assets, you want to be able to hold on to those assets and not suffer big swings or big drawdowns, we'll call them. So if you're already in the end zone, you don't ever want to be put back on the 20-yard line again, right? And that little statement from a client of mine 20 years ago just sticks with me over and over again. And I think a lot of investors, retail investors and institutional investors, really feel that way. They've had a good run. Maybe they've saved their whole life, or they're getting close to retirement. And they're saying, well, I don't want to lose this. And how do I protect it? Number one, that's kind of like the first is do no harm to my portfolio. And then second, how do I grow it? And so you've got to put together a diversified methodology. For us, that includes 4 major asset classes. That includes long-only stocks, and we'll talk a little bit about how the sectors we like in that space. Long-only fixed income, same thing. We'll talk about sectors in there, and I think there's very few sectors that we like in fixed income today. And then that's a long-only alternative asset classes and active alternative strategies. So there's 4 buckets you've got to allocate to. In the last couple of years, we've been leaning towards, in the equity space in particular, more value stock names and less growth stock names. And so that has done well for us, but only up until the last 9 months or so, right? We were adamant about buying value names. These are things like financials and energies and things with very much lower PE ratios, and shorting or getting out of or going less long in the growth names or the tech names. And up until, let's say 9 or 10 months ago, that wasn't a great winning strategy because all of the tech names were rallying, all the FANG stocks, and you can kind of name it. Those are the ones that were the darlings of COVID. But up now, you've seen, and you've had this huge pullback in tech names and a big rally in value names. So there's this kind of volatility and dispersion has created a lot of opportunity in those types of strategies on the value side.
Right. And they're not the glamorous tech names that are that high growth type of stock that really does tend to attract media attention. Let's call it what it is, and attention from individual investors because they're more fun sometimes to be in than one of these old line established value stocks. I mean, do you ever have this conversation with clients, Dick?
Very much. You hit it right on the head. It's much more fun to talk about the next new technology that's going to revolutionize the world. And definitely there are some of those companies that will do that, right? The key is, though, there are some old line companies that can also do that, right? They'll innovate, they'll evolve, they have cash on their balance sheets to actually go invest and potentially buy some of these smaller firms as well. And so those names may look kind of boring because they've been around for 30 years or 40 years or maybe even longer, but they're evolving as well. They're not going to sit there and just grind into the ground and let some new company just take over the world. They're going to innovate too. So we think that is, from in this stage of the market cycle, when the Fed is already telling us they already raised once, they're going to raise a multitude of times going forward. These old line companies that have cash that can actually acquire, merge, and grow, those to us are much more relevant and should be the ones you have in your portfolio today if you're going to pick stocks.
Not sure what stocks to buy and which to sell? Well, no worries. Marketbeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a Marketbeat All Access subscriber. You'll also get Marketbeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. Marketbeat All Access also features real-time news, market events, and performance data for your stocks with the Marketbeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. Okay, so let's jump into some specific. We kind of alluded to some of the sectors that are doing well. Let's jump into those and then maybe talk about some of the companies in those sectors that are leaders right now that you have in your portfolio.
So I'll talk about both sides here because there was this world of, COVID darlings that did extremely well. And
Peloton.
Yeah, Peloton, exactly.
Right.
I think Peloton now is down almost 90% from its peak, right? So it got so far ahead of itself. And I have a Peloton, so I like Peloton, but I don't think, there was no earnings to go along with the stock price that, was ultimately decimated over time. So you've got to be conscious of things that become these kind of waves of, clubs that people have said, okay, we're going to make sure this thing goes to the moon. And same thing with some of the internet stocks are the media companies like a Netflix, which was obviously and still is a leader in that streaming space. But as competitors came out and you got to a point where there's not enough subscribers in the world for them to grow that they grew, it became very difficult for them. On the long side, we like some more stable names. Now, there's one in our backyard. We're based in San Diego, and we really like Qualcomm. Obviously there's been chip shortages. There have been other names that have been like NVIDIA that's really taken to the forefront. But we think Qualcomm is one of those companies I was talking about earlier. They've been around for a while. They've got great management. They've got cash on their balance sheet. They're trading at about a 10 PE ratio, which is extremely low in that semiconductor space. So that's a name that we think if you're going to look for where they're going, they're growing. They're actually supplying chips for cars and the electric car vehicle space. So that's an old school, call it old guard, semiconductor company that we think is well managed and is poised for real growth.
Hey, Dick, let me ask you a question just about the chip sector since we're on that right now. I've kind of heard people talk about it both ways, that the shortages may be pushing back some revenue that they may not book in the next couple of years, or that it may actually pull forward some revenue as they are going into some backlogs. So those are obviously very different scenarios. How do you interpret this?
Well, the company like Qualcomm has been, kind of pulled down with some of that fear that there's going to be this, delayed revenue coming in. But they also have many other businesses. Like 5G they're obviously the leader in that space of 5G. And because they've been such long-time suppliers in this space, via India, China, obviously America as well, they've got long-standing relationships that they've been able to tap into that some of the newcomers haven't been able to. So we're thinking they're going to be a beneficiary more in the near term than the long term. And so that's one of the reasons why we like Qualcomm in that space. And if you kind of switch slightly to a different sector, we also feel the same way about Blackstone, and which is different than BlackRock. We think Blackstone, which is an asset management firm that focuses on alternative strategies in their portfolio. And that's another one that's been around for a while. They've been kind of pulled down slightly with most of the bank stocks, but they're not a traditional money center bank. This is a firm that manages private equity, private real estate, alternative investment strategies. So they've got a very diverse portfolio. And you combine that with something like a Qualcomm, which is a much more sector focused, with an asset management firm like a Blackstone, you really are starting to get a diversified equity portfolio.
Right. So you're looking at diversifying across sectors. Is that the primary way you diversify? Because you did allude to a couple other strategies up front when we began talking.
Yeah, I think if you kind of take the equity bucket, in that equity bucket, generally leaning towards more value-based companies. And that's one sector. I'll call that asset class equities. And in that asset class, we're going to be leaning much more towards these old guard value-based companies. I've been in San Diego for quite a while. Qualcomm used to be the cutting edge, semiconductor. They were the darling. And I think they're going to be that again. People are going to realize, wow, this has been a great company to be invested. They've been well managed, and they're sitting still on the forefront of a lot of these technologies. So that's kind of the equity sector that I'm talking about.
Now, you mentioned fixed income. Let's kind of switch over there for a second. I'm not sure that's where you were going to go, but you did mention something about there are very few things you like in fixed income today. And I understand that completely. And we've had many, many guests on the show who have alluded to the very same thing. So tell me what you'd be looking at as an alternative right now.
The reason we are not huge fans of allocating a large chunk into traditional fixed income is that in a rising rate environment, bond values will go down. So there'll be a time again where we do become a fan of fixed income. It's just that right now, as we see the next 6 to 18 months unfold in front of us, your traditional municipal bonds or your treasury bonds, kind of 5, 10-year, 30-year duration, those are the ones that have been hit hard, and we don't see that changing anytime soon. But there is a reason to keep some traditional, and there's a couple reasons why. One, you'd want to have a little bit of fixed income for liquidity reasons. If you want truly liquid, I would keep short duration treasuries as a potential liquidity hold for your allocation. But also, if we get further sell-off in equities, and the Fed starts to see that we're going to have a negative second quarter GDP, then the Fed might say, well, we could potentially pause a little bit here. And I'm not predicting that they're going to say that, but if they do say that, traditional fixed income will probably rally off of that messaging from the Fed. So if the Fed does an about face like they did in 2018, then you might see a rally in fixed income. We're in a different scenario than we were in 2018 because we didn't have inflation at 8.5% back then. So I don't think they can't really do that this time around. But if they do, you want to have a slice. So that's kind of goes to our bigger picture, 30,000 foot. You want to have a slice of every these four big asset classes. If you're looking for income in the fixed income space, we like the world of private credit. And a lot of people put that into the alternatives bucket, but private credit includes things like what we'll call middle market lending. And middle market lending, these are lenders that lend to companies that are kind of between this $200 million to $1 billion size, which there are thousands of those in the country. And the traditional banks have kind of stepped away from that since the '08 crisis. They've stepped into the very, very large multi-billion-dollar loans they've made. And part of the reason why they've done that is some of the regulations that the SEC has put down on the banks, and as well as the Fed has kept rates low for so long, they can do these very large loans, make a lot of money, and have a very high credit quality behind them in the large banks. But that left this world of great paper between 200 million and $1 billion in smaller companies, I mean, quote unquote, smaller companies, kind of middle market companies. And you can earn yields that are 200 or 300 basis points higher than you would get in, say, a 5 or 10-year treasury.
Okay, so how do investors access those? What are some names that are available to them?
Sure, there's a few, and a lot of kind of blue chip names have come down into this space. So Blackstone is one of them I was mentioning. They have private credit, as well as Apollo and another firm called Cliffwater, which is a very large international consulting firm. And those funds that created are registered interval funds. And an interval fund typically means you can allocate to them either on a daily or a monthly basis. And you typically have quarterly liquidity. So you're not going to get daily liquidity, right? You're going to have quarterly, and there'll be a process to redeem. So it won't be as liquid as traditional fixed income. So you got to be conscious of that. If as an investor, you're not going to have access to this every single day. But you shouldn't expect to, because they're making loans into middle market companies, right?
Right. So how do investors, do they buy the stocks? Do they go in there? Are these UITs? Is there some structure here that whereby investors?
Yeah, you can go to traditional custodians like Charles Schwab, E-Trade, Fidelity, and you can look on, and they're registered mutual funds, but in a category called interval funds. So they're registered with the SEC. They can find them. They all have typical ticker symbols behind them, but they're not traded like a typical mutual fund in that they can get out every single day. It's just a longer liquidity lockup period.
Okay. And that's, of course, how you get your reward from this, by being willing to hold on to it a little longer. Is that right?
That's right. That's exactly right. You get what's called an illiquidity premium. So in some cases, I think a lot of investors will realize if you've got daily liquidity, some people really seek that out. They want to have daily liquidity. They want to be able to get out when they want to get out. But in many cases, that's the worst type of liquidity you should have, right? Some people are their own worst enemies, right? Where they're getting out at the bottom, they're buying the top, they're selling the bottom. And for us, if you're willing to give up some liquidity and go to a quarterly or even a semi-annual, and you don't really need that liquidity, then there's blue chip strategies that you can allocate to, like private credit, that'll actually give you some more yield and give you a higher return potentially.
Dick, I'm looking at the time here, and I appreciate your generosity today in sharing your strategies and your views. I'm sure the listeners are finding this very, very useful. If you had to kind of just sum up what a way to look at the volatile markets are, how investors should respond to these rather than becoming reactive and panicking, how would you say that?
I would say start with the big picture, look out 5 to 10 years, and then apply diversification to your portfolio. And diversification going forward for the next 10 years won't look like diversification for the historical 10 years. That needs it needs a third leg of the stool. You need stocks, bonds, and alternatives. And that third leg of the stool is going to give you the ballast, and it's going to give you some potential returns in a down market, and potentially yield when there aren't yields to get from traditional fixed income.
Great advice there, everybody. I hope you were listening carefully, because Dick just shared some terrific wisdom there from a professional asset manager. Hey, Dick, how do the listeners learn more about what you're doing at AlphaCore?
If you go to our website, which is alphacorewealth.com, you can register right on the site. You can talk to one of our team advisors and research analysts, and we're more than happy to help.
That's great. Hey, thank you so much for joining the show today, Dick. Really appreciate you.
Thanks for having me.
Thanks again for listening to the Marketbeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on marketbeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that Marketbeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of Marketbeat and becoming, as always, a better investor or trader.